In this week's update, is this just a flinch or the start of something bigger? There are numerous conflicting signals, and beware common sense conclusions. It's money flows that really matter. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. What a week. We had lots of volatility, a recovery in America on Friday night, so there's lots to analyse in this video. But there's no question that there's been somewhat of a change of character in the tech sector in America. But when you put it all together, it's more about valuations. It's not fundamentals. And that's the key difference here. This is not a market that needs to go down. It's a market that in some sectors has just got ahead of itself. And Friday night proved that. Before Friday night, it was more difficult to conclude which way the market was going to go. It certainly had plenty of downward momentum. But the Friday night turnaround, which makes it back-to-back turnarounds now on a Friday night, coming into a weekend with all the uncertainties, the US government shutdown, all those things, was a pretty resilient effort, particularly with the broad indices. And it's not surprising because the earnings season continues to be very strong. There's nothing wrong with earnings in America at all. So the fundamentals certainly justify the market not going into a significant correction. Whether it deserves to be at this particular level is up for debate, but it certainly doesn't warrant some sort of significant correction. And I think that's the key thing to remember. What we've seen in the last week, maybe 2 weeks, is that the attitude, the sentiment towards very high PEG ratio multiples has shifted. And for those that aren't familiar with that term, the PEG ratio is the PE relative to the growth. And you've always got to consider it that way because high PEs just not necessarily on their own mean that a stock is overvalued if it's growing its earnings very, very quickly. And if you look in America, there's plenty of examples of those really high PE stocks that had some of their wings clipped on the week that we've just seen. In the Australian context, companies like Car Group, REA, Aristocrat Leisure, Xero, Nanosonics, PME, WiseTech Global, there are just so many of them that for years have traded on what would seem to be excessive valuation multiples relative to their earnings growth. But the reason that the market has been prepared to do that is because of the near earnings certainty. But that attitude certainly shifted last week. Now, whether it's a temporary or it's a longer lasting situation, it's impossible to say at this stage. But it's certainly a change in sentiment or attitude towards those really high PE stocks. It doesn't make them bad investments. They're great companies. But it's just they've been trading at a very expensive level for a long, long time. And in America, it's pretty clear across the week that, as you'll see on the charts, that there's been a rotation by the institutions away from technology, more into financials, energy, industrials, healthcare. So this is not general risk aversion. This is not get me out of the market because we're going into a protracted correction. This is just a rotation that happens normally. So it's important to understand that that's what is unfolding at the moment. And it depends, how you play it depends very much on your plan, your specific purpose for each transaction. And you can have different purposes for different stocks. You don't have to do the same thing for every stock. You just need to be clear what the purpose is. What do you expect that stock to do for you? And also the timeframes. So for me, analysing it all, I wasn't quite so sure until we saw the Friday night session in America. I think this is very much about hot pockets of the market, and there's certainly plenty of those in America in technology. They're just going through a healthy reset that will set up great long-term opportunities. So that's the big picture. Now, the US reality for the week is we saw a mixture of good and not so. We've got profit margins that in some quarters, so again, these are not general statements across the whole market that apply to every sector of the market. This is just some sectors. Profit margins are stretched. And we've got a shifting attitude in terms of valuation multiples. And it may well be that we'll get some reduction of those PE multiples. Stocks that are trading on PEs of 100, those PEs might get knocked down to 60 or 70, which means that the price, all other things being equal, the price needs to come down by that much. But that is not in itself a reason to desert the market. And certainly the fact that in the US we've seen a rotation of funds, not an exodus of funds, is the key point to remember. So it's very much a risk of sector-specific or industry group-specific sell-off. It's not a big correction. The positives with respect to the US market is that generally earnings are strong. They're right up there at the higher end of what normally happens during earnings season. And there is still plenty of liquidity to keep this rally going, and you certainly need that, because once you've run out of buyers at those levels, then the market is then vulnerable to a correction. But there's plenty of liquidity to keep this going, so there's quite a few positives in the US market. If we look at the Australian reality, the negatives here, well, rate cut hopes appear to be dead, possibly through to the end of 2026. There are some valuation concerns, and I've highlighted companies such as CBA over the last 12 months and how expensive it was, how excessive that PEG ratio was. Well, CBA is certainly getting some hammer at the moment, and I think was down around 9 or 10% across 2 days last week. So those valuations, the attitude to valuations is certainly shifting. So if you're looking at your portfolio, it's best to trim the crowded, very expensive trades. And there are plenty of those in America, and there's certainly plenty of those in Australia as well. So if stocks that you own fit into that category, then you don't want to cross your fingers and hope that they're going to go back up again, because the momentum is now against you for those kind of transactions. There are positives in the Australian market. Commodities are strong and have got big sustainable tailwinds, no question about that. And there are still plenty of excellent buying opportunities. I'm constantly in a position of not having enough cash to buy all the things that I would like to buy. So there's still good opportunities here. It's just a matter of being focused on what is the correct type of stock for you. So just in very general terms, and everyone needs to make up their own mind here, and that's why you need a plan, because you can't make up your mind what to buy unless you've got a yardstick to compare it with. But the actions that you should consider, I think, that is prudent now that we've come into this period of shifting attitudes, which can do a fair bit of damage to a stock's price. I think it's prudent to demand lower entries. There is a rotation happening, so there will be opportunities in different sectors, and they may be different to the sectors of the recent months. So take advantage of it. Now, we're not there yet by any stretch of the imagination, and everybody knows that a broader, deeper correction across many sectors, or the majority of the market, is absolutely inevitable. But that might be next year, or the year after that, or it could be next week. We don't really know, and that's why it doesn't bear really too much thinking about. We manage risk in other ways. So inevitably there will be something that we typically call a significant market correction, but we're certainly not there at the moment. So taking significant action on what we saw last week just can't be justified. So there's no need for panic, and certainly the market was saved to a degree by the fact that the US market rallied on Friday night. But I think it's also prudent to be thinking about some sort of portfolio preparation. Identify what is not a strong conviction stock. So what is a stock that you're not particularly committed to holding for the long term, or a stock in a at-risk sector or trades at an at-risk multiple, whatever it might be, or market darlings that have got excessive valuations that are starting to lose momentum now. You don't have to desert all of those really strong trends, but certainly where there's excessive valuation and the market is showing you that it's losing momentum, then you really want to think about how committed you are to those sort of stocks. And certainly don't buy what's expensive. So I think you want to be buying more prudently You certainly don't want to buy something in the hope that it'll go up. You're on a hiding to nothing if you do that at the moment. So there's some actions that you could consider depending on your plan and your personal circumstances. And on that note, we always strongly advise that you obtain whatever other information that you require. All right, let's get into the specifics now. The S&P ended up flat for the week, which seems quite extraordinary given where we sat through Wednesday and Thursday and even the opening of the Friday session. The Nasdaq was down by 0.5%, and that was because it has a higher proportion of tech stocks, which certainly there was a rotation away from during the week. The Russell was down 1.7, so a little bit more selling in the small caps, but that's normal when the VIX spikes. But the key things to me are that we've had now back-to-back Friday bounces. So the previous week, the US market looked on very shaky territory, but turned around nicely on the Friday, and the same again. And when you're heading into a weekend, if there was more significant nervousness in the market other than just a sector rotation, then I doubt very much that would have happened. But it certainly created a bit of a confusing picture throughout the week. I had a real tussle in deciding which way the market was likely to be heading, what the signals were telling us. So I think this is a reset of the most extended part of the market. It's certainly not money flows going out, but the added volatility, as you'll see when I go through some charts, that certainly sends a message. So there is some change of character happening in the market, and we shouldn't just dismiss that and think the market rally will just continue on. Some degree of pre-preparation needs to be done. The index was down slightly, the currency index down to 99.27. The yield went up a little bit to 4.14, but it's been in this area now for some time. The VIX did spike above 22 during the week, but finished at 19.8 following that Friday session. So let's jump in and look at some charts. And I'll just look at a couple of individual charts. As you know, I would never work off the indices because they don't give you enough colour on what's really happening under the hood in the US market or the Australian market. So looking through hundreds of charts as I do, there was a pretty consistent theme, and I've just chosen Amazon here as just one example to try and decide, is it just a change of character in a more significant way, or is this just a normal retracement? So let's look at what we've got. We had a huge gap on earnings after their earnings on October 30. Huge gap up. We then gapped up the following session and then started to get into a bit of a volatile period for a week or 10 days. So there's no question that there's more volatility here than there is back here. You can see we've got gaps and long tails and longer candles all over the place. So the character of this period is different to the character of this period. So that's the first thing to observe. The price has now come back and filled this gap that was created on the earnings report, and that's technically nice and orderly. But we haven't seen a real decisive break of support. Thursday finished right on support. Friday gapped down, but then we ended up with a real doji candle, which just tells you that we're in balance between the buyers and the sellers. They couldn't decide who was going to win the war on the day. It's a pretty wishy-washy chart and certainly doesn't say anything definitive about a correction. Yes, there was a gap down on Friday because the futures had tracked down another 1.5% before the market opened. But as soon as the market opened, a lot of stocks started to rally straight out of the gate. There was no real hesitation with a lot of stocks. Now, if we look at a stock like iron, for instance, in a very volatile sector, but it had just got too hot and too crowded. The price had gone up 700% from $10 to $70 in about 4 months. And it was a stock that was being discussed and hyped on all sorts of different social media platforms. Now, since then, the price also got extremely volatile, but has now pulled back very significantly. Is this the low? Oh, I couldn't really say, but this is just the sort of the pressure relief valve that is a good thing to happen because it prevents a bigger correction in the future. So this sort of activity is to be seen as a real positive. Let's look at a stock called AMD. When you look at all of the action here, I mean, they had a terrific surge and gap on their earnings in early October. This just looks far more like a sign of a very robust market to me, because we're still fairly close to the high. When you get a major top where fundamentals have changed, it's not orderly. There's lots of significant movement and we get breaks of support. That hasn't happened here. At the moment, this is just a high-level consolidation, and there's no particularly high spikes on volume. So the next 2 weeks are really critical from my perspective because the market could break down from here. But I think at this point in time, it's the low probability. So I think this is just a positive rotation rather than institutions deciding that it's all over for the next 12 months and they're deserting. It's certainly not AI cooling off because from a fundamental point of view, there's no suggestion that the degree of capital spending is cooling off at all. This is just a bit of an adjustment in expectations because expectations had just got beyond reality. So I think the AI trade from here is not off the menu, but you just need to be more selective. You need to know more about what you're doing. You need to choose more prudently. So that's how I'm seeing things in America. And there were plenty of stocks. This is an ETF that this one will do. There are plenty of stocks where the pattern looked like this. And this was the previous Friday. You can see very strong recovery after a gap down on the open. This was a carbon copy. We gapped down on the open. We traded down, in this case, a little bit, but then it just shot straight back up again and ended up in front. And there were a lot of American stocks that look like that. Let's go and look at some of the indices now. The NASDAQ looked pretty much like the last chart that I showed you, but it's the relative comparison. I'll look at SMH. So this is semiconductors. So again, there's nothing dramatic there. There's nothing that signals that we've got a desertion from the market. Now, this is a really interesting chart. So this is the chart that I've been showing for a long, long time, but I've just extended the time frame first of all. And I've added in the green line as the S&P 500. So you can see that over the last 12 months, there's only 2 sectors that have outperformed the S&P. XLK, technology, and XLC, which is communication services, both the more aggressive parts of the market. Every other sector underperformed the S&P. So that's the big picture backdrop. And that's what's been driving the indices. Now let's come in and look at the last fortnight. This has changed completely. We've now got healthcare at the top. Then we've got energy. Consumer staples has certainly made a comeback. Materials as well. So these are all the things that you would expect to see in a sector rotation that's going a bit more defensive. Then we've got XLF, which is finance. And then right down the bottom, we've got XLK, technology, and XLY, which is consumer discretionary. So we've had a complete shift in the last 2 weeks from what has driven the market for the last 12 months. Now, will it last just a few more weeks and then we'll get back to normal? Hard to say. But the prudent thing to do is just be more discerning, more conservative. If we look at the Australian market, again, on a 12-month basis, and I guess the first thing to note is that our market is totally different to the US by sector, certainly the domination by a handful of big caps. If you look in materials, you look in finance, there's just a handful of stocks that really do have an outsized impact on the market, on the indices. So that's why I don't worry too much about the Australian indices as a guide, because you're really just looking at a couple of large stocks. But the thing to notice about the Australian market is that we had outperformance over the last 12 months by materials, by small caps, by energy. So they were the ones that outperformed the ASX 200, which is this green line here, and of course finance. And at the bottom, because of recent underperformance, we've got information technology and healthcare. And again, the impacts there are very stock specific. In the case of healthcare, it's CSL really dragging the index down. In the case of information technology, it's WiseTech Global that has been really weighing on the sector. But again, if we come in and look at the last 2 weeks, then we see, again, quite a significant shift. Materials are still up there, so they've held up quite well. Energy's made a resurgence, but such an unpredictable sector with the oil price. Healthcare has made a bit of a recovery on a relative basis, but because it's information technology that absolutely got hammered in the last week, and we saw a very broad sell-off across information technology in Australia, and even the banks, thanks to the selling that happened in CBA. So all markets are rotating, they're shifting in terms of the leadership to varying degrees. The S&P, again, looks very similar to the NASDAQ. 2 Friday night back-to-back positive sessions after big gaps down and trading down. The RSP, the equal weight index, you can see, very quiet. So if you remove the impact of the Amazons and the Microsofts and the Apples and just have them at the same contribution to the index as every other stock, then you can see not much happened. This was largely about what was happening in the larger cap stocks. And there's the Russell. So significant selling on Thursday, but a good recovery from a bad start on Friday. So that's the US market. If we look at currencies, not a lot has changed with the US dollar in the last couple of weeks. And similarly, the Australian dollar hasn't done very much at all. Now, moving on to the Australian indices, there's the ASX 200, which obviously reacted very badly to the Thursday night session in America. So I would expect that we'll probably see some recovery in the Australian market on Monday. If we don't, then that again tells you something about the thinking of institutions and investors in Australia. So we'll have to wait and see. All right, so just summarising the Australian stocks, 64.76 is where we finished. The stronger jobs data kills the rate cut hopes, possibly through into 2027 or even longer. It really has become very unclear, and the RBA is certainly in a very difficult spot at the moment. 1.55% for the week was where we ended up, but I would expect that we'll probably see a bit of recovery on Monday. So it was the third consecutive down week for our market. We're 5% off the peak though. I mean, the last 2 weeks have felt awful. Portfolios took a bit of a hammering if you had a bias towards the more aggressive growth stocks. It just feels like the Australian market is down more than 5%, but that's it. We're still looking for a low, but I suspect we might see that. And of course, information technology was the big decliner for the week. And again, on valuation grounds, because nothing has changed with the businesses, the underlying businesses themselves. Companies like WiseTech Global have been hammered because of governance issues, but the actual business itself and the businesses of other major technology stocks are still going along very nicely. So it's a matter of just, I think, going back to basics, recheck your basics, make sure that almost all of your portfolio is exposed to the 6 or 7 mega trends that are out there that create a really strong tailwind for earnings. Make sure you're clear about what weighting you want your portfolio to be to each one of those megatrends. So this is just a sequential thought that I step all new members through. Next step, number 3, is identify the best of the best in each sector. Why would you want to buy anything else but the best of the best? It's not logical. You don't want to buy your favourites, particularly if they don't fit into that category. And if you don't know how to identify the best of the best, then get some assistance, because that's really all you should be investing in. There is so many to choose from. Next step, make sure you get good entries by weakness. And so last 2 weeks are setting up that opportunity. And the final thing, and the thing that investors tell me that they struggle with the most by a clear margin is to have an exiting plan, a repeatable, consistent exiting plan so that you're not getting out at the top, you're getting out just a bit after the top. But it's an exiting plan that gets you out quicker than just about anything else that I know. So a good time to get back to the basics. Turning now to precious metals, gold was up $83 for the week to 4083, so a bit of a resurgence there, even though we did get a bit of selling on Friday. In Aussie dollars, incredibly profitable, 62.42. Silver finished at 50.54, but was trading up around 53.5 at one stage, so it was a bit of an uncertain finish for silver. Now, will that continue, or are these the tops? That is the big debate at the moment. For me, from a fundamental perspective, gold is going through and has been going through for the last several years a structural repositioning in the overall world of investment. When you look across equities, you look across bonds, you look across cryptocurrencies, you look across all the asset classes, there is a structural repositioning going on with gold. And that is almost certainly not going to change. So the long-term tailwinds for gold look as good as ever. When we look at the fundamentals around silver, it's on track for the 5th successive year of supply deficit. And on top of that deficit, we've got escalating and sustainable drivers. That's the most important thing. These are not short-term escalating tailwinds. These are sustainable drivers. We're talking about silver use in solar panels, in electric vehicles, in medical and electronics. And now silver's been added to the US critical metals list. So when you've got a market that's in multi-year deficit anyway and finds it difficult to bridge that gap, because in many mining operations, silver is a byproduct. It's not the reason that they're there. So it's not as simple as saying, well, we'll just increase the output, because the output is what it is. It's a consequence of what else is being done with respect to gold or base metals. So it's not that difficult to see that we could see a continued surge in the silver market. And when we look at precious metal stocks, gold stocks are in a very strong continuation move. Now, we ran into Friday and the Fed made some hawkish comments, but that's just one session. So I don't think you can read what happened on Friday in any other way than just that was just a single session. That was a bit of a mixed finish for stocks. Let's go and have a look at that. We'll start first of all with silver. So on a daily chart, so we've formed a big double top up here, and it's become very, very volatile. The peak was 54.50, and then the low just a couple of weeks later was at 45.5. So we dropped $9. Then surged back again just as quickly. And then Thursday, bit of indecision. So coming off that big double top, we were then trading positively on Friday, but lost it all towards the end on those hawkish comments. But there's nothing can be concluded from this, because this move down off a double top is normal. It's going to happen more times than it's not. So this is just a reaction from the normal dynamic of selling that would occur in the market. So not enough information to see or to know what's going to happen in coming weeks for silver. But certainly with another week's worth of data under our belt, we'll know more. This is gold on a daily chart. You can see it was going along very nicely. Friday's session certainly took some gloss off, but you can see there's a tail here. That means buyers stepped in towards the end. So just another garden variety backwards and forwards in the gold market. And there's the gold price in Australian dollars. I'll just go and look at GDX. So that's the Aussie index. So I would expect that we'll see a bit of a negative candle on Monday in the Australian market. But we've bounced off, this gap got filled, and we've bounced off that a couple of times. So this is still looking very positive. So this is a weekly chart. And if we look at GDXJ, there's nothing terribly dramatic there. So everything's still in place for the precious metals rally to continue. Turning to other commodities, copper has clawed its way just back above $5. There's no long-term change here. The long-term electrification demand is intact. It's just a matter of when it really starts to kick in and push that price up sustainably above $5. That's being offset by just the short-term fears about soft demand, be it from China or the rest of the world. But I would observe that there are some great development projects in Australia. And if you look at the economics of their pre-feasibility studies, these projects are absolutely fine with copper at $4.50. So for these commodity stocks, you don't need copper to be $6 a pound to make the project viable. They're viable in spades right where the copper price is now. So it's a matter of determining which of the projects that are significantly viable, even if the copper price does come off a little bit. So that's the good news. If you've got a plan, you've got patience, there's highly likely to be quite a few 10-baggers and beyond, because these copper development stocks have hardly got momentum at the moment. Some copper producers, like Sandfire, for instance, they certainly do have momentum, but the development stocks do not. So if you focus on buying the best of the best when it comes to development stocks, then you've got the potential for some extremely good future rewards. Crude oil finished just above 60. The balance looks more to the downside. To me, the upside looks capped. Hard to see what would drive the oil price back up into the 70s again. And there's certainly more things that could drive it down into the 50s. So that's how I think the energy market sits. Here's the spot copper chart. So we've just been fluctuating between 480 and 520 now for some weeks. So wrapping it all up, the final message is the next 2 weeks is really critical. We're not out of the woods, but certainly as I've been going through, there's a lot of positive signals that can be taken from what has happened in the US market in the last couple of weeks. There is enough evidence of a change of character just to reconsider your plan and consider what you might do in preparation. And as much as possible, you've got to keep the emotion out of it. The worst thing you want to do is take a perception from this video and then just automatically go and decide you're going to dump a whole bunch of stocks. You've got to keep the emotion out of it and just work through it in a sequential fashion. You need to think about what sort of investor are you? It's really important. Are you the kind of investor that is pretty intolerant to volatility? And if we were to get some downside over the next few weeks or few months, then if you're not going to take that too well, it's probably best to make some adjustments, because you're at risk of selling out when things get really extended to the downside, and that's the worst time that you could be looking to get out of the market. The other kinds of investors are more resilient to volatility, and that's just a matter of being what it is. If that's who you are, then you need to respect that. What does your plan set out during periods of corrections? And if you don't have a plan that sets out what actions you should take, whether you cash up to a certain level or whatever actions you might take, then you better get one pretty quickly, because if you're making just emotionally based decisions as the market unfolds, you're going to get a worse result than if you've pre-planned for it. So I think it's a time to be more selective on stocks, to focus more on stocks that have got strong balance sheets and resilient earnings, where you're looking at companies that are already profitable. So that's the final message from what has been a pretty volatile couple of weeks. Portfolio analyst last week, we looked at uranium, the outlook for uranium and also the opportunities, and also a bit of an update on precious metals. So that's it. It's been a big week. I suspect the volatility will continue to a degree for a little bit longer. There's more information on the website about what we do, and there's my email address, and I'll be back with you next Sunday. Cheers.